Yeah, so I just think that we're in these situations where, particularly in technology, because so few people really understand it, they want to believe in this idea of divine intervention, and it's just not true. And so a lot of our success at Facebook was about the diligence of working every day. Again, back to the process, the practice, not the outcome. And so when I started this organization, a lot of it was about rebuilding that kind of infrastructure and that capability to have very unemotional, fact-based decision-making. And so how that manifests is that whenever we invest in a company or we have an idea about starting a company, we try to implement tools and systems that allow us to understand what's really happening on the ground, meaning the actual atomic level data that the business is generating while it's trying to do whatever it's trying to do.
Social Capital founder Chamath Palihapitiya, known for sponsoring a wave of SPACs or special purpose acquisition companies that brought speculative tech companies to the public market, is now calling the era of low interest rates a mistake. Prior to founding Social Capital, Chamath was an early member of Facebook's senior executive team and led the development and launch of new platforms that drove the company's tremendous global growth. Before going further in this video, make sure to hit the subscribe button for more recent updates. It's not higher interest rates that are the problem, it's the transition from stupid, free, incredibly ridiculous money at zero cost to something more normal, Rich Handler, CEO of investment bank Jefferies, said. The company recently announced that the number of Facebook's daily users hit 2 billion for the first time, but between inflation eating into advertisers' budgets and fierce competition from apps such as TikTok, those users are not bringing in as much revenue as they used to. Fintech companies are having to rethink how they approach their identity and access control strategy to ensure that their platforms are equally trusted by both consumers and businesses. To stay competitive in this very crowded arena, fintech companies need to keep a tight grip on security and privacy from day one of development, especially as third-party services continue to grow.
There are really two kinds of companies now in the world. There are the disruptors, and then there are the disrupted. And increasingly, it's really crucial to be able to understand who the disruptors are, and then also the implications of what they're building so that you understand how to fix the disrupted. And the reason why I think that's important is that, too often now we go to the lowest common denominator of this dystopian world where the robots and the cyborgs all have jobs and the rest of us are kind of, trundling from one random task to another, and it doesn't have to be that way. And so for me, what I'm trying to build is an organization that invests in some of these disruptive technologies, that allows people to be trained in those jobs, that allows us to have an economically vibrant fabric, but at the same time learns from those companies that would otherwise be considered part of the disrupted class, and to help them, frankly, be more sustainable.
The U.S. government has launched the Disruptive Technology Strike Force, a collaboration of U.S. law enforcement led by the Justice and Commerce Department to stop hostile states gaining access to critical U.S. technology. Assuming the debt is financed through money printing and ultimately inflation at $306 billion is the supposed contribution to the war on inflation. This sum represents less than 6% of the current U.S. monetary base, less than 1% of current public debt, and just a fifth of the budget deficit registered in 2022 alone. The strike force, announced last week, will bring together experts to target illicit actors, harden U.S. supply chains, and protect critical technological assets. The department has also updated its regulatory tools to ensure protection against foreign investments in U.S. companies for potential national security risks, screening foreign investment in U.S. companies for potential national security risks. This period of relative stability may be about to end. In the last 18 months, the industry has seen a sharp increase in demand. A diverse and expanding set of lenders, large banks, regional banks, online retailers, and fintechs are considering moves into this asset class. In the mortgage market, low-cost digital attackers have been gaining significant share, and retail payments have seen the emergence of buy now, pay later players. Auto financing, by contrast, has experienced relatively little disruption over the past decade.
People want very crisp, clean narratives to describe really grandiose things that happen in the world, whether it's winning championships or whether it's starting and building great companies. And the actual facts underneath are much more complicated and nuanced. There's all kinds of tension, physical, emotional, mental, that go into creating something excellent. And so, like I said, the first goal was be good at one thing, which is to identify and incubate and nurture disruptive technologies. What I would say is actually, I gave myself a 15-year target, and I think that in the first 7 years, we've come to a place where I have high confidence that we know how to do that. And so now in many ways, the next chapter starts. And in chapter 2...
Does that mean you did it in twice the time you expected?
In half the time? Yeah, I thought it would be like a 15-year thing, and I think, by year 7, I think we have a good handle on how to do that part of the business. And so in many ways now chapter 2 has started, and in chapter 2, what it's about is now being able to take those technologies and apply them constructively to change markets for the better, but at the same time, take all the knowledge that you learn from them and apply it to some of the legacy businesses and see if you can't improve those as well. And the reason why that's important is I think like true knowledge will come from understanding both sets of companies. Meaning, sometimes people want to be very dismissive of how things have been done. And in other cases, people want to be very dismissive of new ways of doing things. Neither are the way that you have maximal impact and success. So what I mean by that is there are many things that, when I was at Facebook that we did that were pioneering. But frankly, there were many things that we did that were just copies of things that were tried, tested, and true. And so acknowledging the fact that the nuances of doing anything great will rely on both sets of information and knowledge. And so for me, now what I'm trying to do is say, okay, on the one hand, can we build the next great chip for machine learning? Yes. But on the other hand, can we actually help a company that employs hundreds of thousands of people in the world how to leverage that technology to keep those employees fully employed? That's a great challenge. And I think the answer to those questions will allow us to both profit from being at the seat of creating these disruptive technologies, but frankly also making sure that they're allocated in humane and ethical ways.
In 2023, there are 10 fintech trends that are particularly noteworthy, including the rise of decentralized finance, the adoption of artificial intelligence in financial services, and the growth of digital wallets and contactless payments. As consumers increasingly embrace these technologies, it is important for businesses to stay ahead of the curve in order to remain competitive in the digital finance revolution. The Inflation Reduction Act will finance projects over the current decade and relies entirely on higher tax revenues to the tune of $739 billion. The increased accessibility, efficiency, and affordability of financial services have the potential to enhance financial inclusion and drive economic growth. The size of the global fintech market was estimated at $110.59 billion in 2020 and is expected to increase at a CAGR of 20.5% to reach $699.50 billion by 2030. If you enjoy this tech conversation and find this content interesting, then give this video a big thumbs up and do subscribe to our channel for more recent updates about business and finance.